welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Jamie Ross, manager of the Henderson UK Alpha Fund. Hi Jamie.
Hi Emma.
So UK fund, UK stocks, FTSE 100. It's been a pretty interesting start to the year, hasn't it? The FTSE 100 is officially in bear market. What does that mean?
Yeah, it's been tricky. So the FTSE 100 as we speak is down probably about 8%. The FTSE 250 down, kind of similar, a little bit worse actually so far this year. Very tricky start. So what's driving the market and what are the things that people are thinking about? Well, last year and into this year, it's been all about China. So it's been all about the slowdown we're seeing in China, the knock-on effect of the currency devaluation we've seen there and the potential for currency devaluations competitively across Asia. But also what we're seeing is that we're seeing the start of a rate cycle in the US at the same time as conversely economic data is just starting to slow down. Those two things are concerning people. And then to put kind of the icing on the cake, there's now concerns over illiquidity in the bond market, and that's starting to really concern people. Illiquidity combined with the fact that we've seen a big sell-off in high-yield debt. All those things mean that equities are down quite a lot to start the year.
And I suppose that's a good point to make about FTSE 100 stocks, in particular in the UK, is actually it's a global play. It's not a UK play. So the fact that there are concerns in emerging markets across the pond all impacts UK equities.
Absolutely right. FTSE 100 is such a diverse index. And these days, the big sectors are, banks, mining, oil and gas. All of these things are not driven by how the UK economy is doing. They're driven by how the global economy was doing. And what's interesting about that is that last year, that almost completely explains the performance of the FTSE 100 and the 250. The 100, much more international, getting a hit because people are concerned about China and a global issue. Whereas the FTSE 250 was much more resilient. What's slightly concerning this year is that actually the FTSE 250 is doing slightly worse than the FTSE 100, even though we're still seeing all these international worries.
I suppose with that backdrop, the question is, how do you invest in UK equities when all that's going on?
I think what we try and do, and sometimes it's difficult, but we try and really stick to what we're good at. So what are we not good at is trying to predict market levels, trying to predict where the FTSE is going to end the year and trying to position ourselves accordingly. But what we hope we're good at is finding the right companies and investing in those. And also finding companies that can survive throughout an economic downturn and companies that have resilient business models. And hopefully that's something we're doing at the moment. But as I say, it's been a tricky start to the year.
And is this the new norm? I mean, they always say whatever you're doing on the 1st of January, that's what you're going to be doing for the rest of the year. If that's the case with the markets with the first day of trading, then we're in for a bit of a sticky year.
As I've been reminded by a few people, the first 2 weeks of the year quite often set a signal for the rest of the year. So it's slightly concerning. But are we going to change the positioning of the fund dramatically because we're worried that markets might end the year lower than they are today? No. We'll stick to what we do best, and that's picking stocks, picking the right businesses.
Jamie, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.